A lot can certainly change in a year. Last year at this time, I spent a great deal of time convincing investors the sky was not falling. As you may recall, the Fed had hiked interest rates for the first time in nearly a decade, and both the stock and the bond markets were selling off. There were some very scary sell-offs early in 2016, but the Fed quickly changed their tune and the market bottomed. Heading into the election, I found it interesting how spooked market investors were by the prospects of a Trump presidency. But shortly after he won, all those ideas quickly changed. Now we're seeing investors declaring with confidence what they believe the next several years will bring, despite few people imagining the types of celebration the markets would be having after Trump won the election. Remember, most market experts thought the market would crash if Trump won. So if you look at it, the assessment of the economy really boils down to what your political leanings were. I've heard some people say it's the best recovery ever. Others have said it's the worst recovery ever. So who is right? Actually, they both are. If you want to look at it, those who say that it was the best recovery of all time, obviously they favored the last president. But if you look at the consecutive number of months that we created jobs in our country, it's unprecedented. Even the booms in the 60s and 70s saw months where our country lost jobs. So the statistics say technically that's the best jobs recovery ever. Then on the other side, those who maybe didn't like the last president or supported our current president will argue that it's the worst economic recovery. And they're also right too, because they're looking at GDP growth. If you look at what they call the post-World War II era, which is when they really began keeping solid economic statistics, we've never seen a recovery this weak. We only had one quarter going all the way back to 2009 where growth was above the long-term average. But you know what? It really doesn't matter what you call the recovery. What matters is what's ahead for the future. Now, I have up here an example of a classroom economic cycle model. I always say classroom because as I've told my kids who are now at the University of Arizona that, economic, classrooms are different than the real world. But it's essentially what happens with the economy. So you have a boom, then you have a recession, and then you have a recovery. Now, if you look at it, off to the side there, you see what a lot of people supporting the Trump administration, as well as the president himself, have said during the entire campaign. We've been going down for 8 years, and now the sky's the limit. And then at the top, you have people saying, we're going to have inflation, the government's going to spend money like crazy, we're not going to get the growth that we want. They think we're at the top. But then there's the other school of thought, and this is actually where SEM's economic models put us. And again, most importantly, our models are based on data, not my opinion. The models say, hey, we haven't had a recession. That means technically we're still going up. But we actually are seeing things accelerating. You look at consumer sentiment, small business optimism, manufacturers' new orders. All these things are showing that there is still room for growth. And as of right now, our models are saying we're somewhere around the 3% growth rate on an annual basis. Not quite above average, but hey, it's better than we've seen. So the real key, and I place a big asterisk on what's my outlook is the infrastructure and investment spending. I've said for years, that is what we need to do to change the structural issues with our economy. If you spend money on infrastructure, if we see businesses and the government investing in long-term projects, not just giving money away, whether it's to buy back shares or to give money to the citizens, but actually investing for the future, we tend to see much stronger jobs growth. More jobs means more economic growth. Really, what turns into the biggest unknown and what's fighting this infrastructure spending, the tax policies and everything else is what is going to happen with the president. There's something that I see happening that's called representativeness bias. When our brains are trying to get around something that's unknown, and you can't have a bigger unknown than President Trump, we've never had a president like him, but our brains try to say, this is what I think the situation is like. So we've had those who supported him, have said, this is the second coming of Ronald Reagan. Hey, I even heard it last night on Fox News. That'd be great. A lot of his policies line up with Ronald Reagan, but there's a lot of things that don't line up, but we don't have time to go into that today. Now, those who do not like President Trump have used different comparisons. I think they were being generous if they said he's like George H.W. Bush, and in other words, he's taking over from a boom and he's going to throw us into a recession. I've heard people call him Herbert Hoover, which I guess that's, if a Democrat wants to insult a Republican, they call him Herbert Hoover. And then, of course, you have those on the clear fringe calling him, Adolf Hitler. I don't think it's any of those people, and that's what the real issue with representativeness bias is you don't know. You can't take one person and make them fit into a specific box. And really the big issue we're going to have with our country is there's so many people that dislike him. Whether you believe all the vote counts, from one side or the other, basically half the country voted for him and half the country didn't. And now we have people in Congress, about half of them like him, half of them don't. His policies won't get done, but more importantly, if we start to see this divide in our country grow instead of coming closer, it's going to be hard to accomplish things. So going back to representativeness bias, I heard somebody comparing him to Grover Cleveland. Now, like most of you, you probably don't remember Grover Cleveland because it happened before our time, so I had to look it up and see what he did. Apparently, Grover Cleveland made some things that made people, in Washington at the time say, who is this guy? He made appointments based on merit regardless of political affiliation. He didn't mind upsetting people. He inherited a deeply divided country following the Civil War, and they found that he had inconsistent views. Sometimes his social policy didn't line up with the party. Sometimes he had differing social policies that some people said didn't line up. And often he implemented those policies without consulting the people around him. So I guess if you had to pick one comparison, that's, Grover Cleveland would be it. He was a wild card. Maybe not as big of a wild card as President Trump, but the closest thing we can get. Now, it's important to understand, it's not going to be like any of those situations. So when you have an unknown, the best way to overcome this is to keep an open mind and focus on data. Data is the only thing we can use to overcome our emotional biases. That's one of the advantages of using SEM to manage your investments. Our opinions on the president or a specific market sector has nothing to do with where or how we invest. So if the data says, hey, you should be in the market, we'll be in the market. I don't care what I think about the president. We follow the data. Same way if it says we should get out. Maybe I like the president, maybe I don't. I'm going to follow what the data says. That's really the only way to remove both our own behavioral biases and then to help our clients and advisors overcome theirs. You get that out of the equation and everybody else is better off.